We're sketching the rhythm of the economy. It's obvious what's working now in markets, but what comes next? That's where the real value is. The four-phase business cycle just might have the answer. On the x-axis below, time. On the y-axis, GDP, economic growth. Let's begin with expansion. Expansion occurs when cyclical sectors like technology and consumer discretionary, they lead markets higher. Expansion is then followed by the peak. The peak is known as strong trends reach a crescendo, volatility rises, and defensive positions stabilize. After the peak comes a contraction and a recession. Cyclical sectors stumble, capital flows away from the market leaders. Defensive sectors offer stability and a safe haven of capital. And then finally, we see a trough and a recovery. That occurs when broad markets establish a bottom and new cyclical leadership emerges. You can pause the video and take a screenshot if it's helpful. This is our four-phase business cycle. We're going to show you where we think we are right now and what may come next. In terms of the business cycle, well, there's very specific sector performances. For example, during expansion, we have technology and consumer discretionary. They lead markets higher. The laggards include healthcare and utilities. That's followed by the peak. Energy up 20%, healthcare up 16%. Financials and utilities, those are the laggards as well. That's followed by contraction and a recession. Healthcare is the best performer, followed by consumer staples, also defensive play. Industrials and technology, they're negative during that period of time. And the trough recovery, that's led by broad markets and technology. Healthcare is up, not as much, as well as utilities. Now, by the way, these statistics were taken from the annual returns across multiple years. In fact, between 2000 and 2024 for each cycle phase. So, how do we make the sector bets with exchange traded funds? Well, these are the major different exchange traded funds and their respective sectors. Let's take a look at the expansion phase. Now, to be clear, there is not, or normally not, a clean break between phases. The expansion is sometimes a combination of expansion and a peak. So, use this with a grain of salt. However, during a pure expansion phase, we see the best performers include consumer discretionary, home builders, network and semiconductors, retail, a lot of technology. That seems to work best, kind of like where we are right now. That's followed by the expansion that leads to a peak. Well, communication services and financials, they seem to do well, but we see a rotation into some utilities, some defensive plays like industrials, materials. Retail still does well as software cloud. A true peak and the beginning of the contraction, we see energy rises, metals and mining rise, maybe during the contraction as the Federal Reserve's cutting interest rates. Well, that helps gold and silver. Aerospace and defense. And by the way, take a look at real estate. We're not talking about home builders. We're talking about XLRE. That's a real estate investment trust type of model. We've spoken about this in the past compared to XHB, the home builder. Real estate investment trusts collect rent, and those are usually the best performers during contractions. And then the contraction, where healthcare by far is probably the best position to have, that's followed by the trough, the bottom that leads to recovery. Healthcare still does well, consumer staples, pharmaceuticals, utilities, lots of defensive plays before we begin the next expansion phase. So the question is, what's working now? Well, that's pretty easy. Technology. Take a look at AMD today. Well, those big news, and the stock is up a lot, around 27% at the moment. This is a pure technology play and a lot of evidence that technology, specifically select technology like AI, seems to be working very well these days. But we have a decision. We always have a decision. Should we place our bets with growth? The trend is your friend, like technology, specifically AMD. Do we continue to bet that's going to go higher? Well, there's a good chance it may, especially with the anticipation of lower interest rates. Or do we want to look beyond that? Maybe we want to look for some value, things that the market's forgotten about, like defensive positions, like healthcare, for example, specifically the ETF XLV. Now, we took a look at XLV, and we took a look at that compared to the S&P 500 over a number of years. And we can see, for example, 2001, this was the first interest rate cut during that cycle. XLV was up 1.2%. The S&P 500 was down 9.3%. You see, after the first interest rate cut, it's thought that's the beginning of the economic contraction. So XLV outperformed the S&P 500 by a factor of around 10%. We take a look at the first interest rate cut in 2007. Well, XLV was down 14%. But the problem was the S&P 500 was down 18% during that period of time. XLV helped preserve capital by a factor of 4.6%. In 2019, the first interest rate cut, that led to a 12-month performance of 18% for XLV. However, the S&P 500 was up only 11%. And again, in 2020, XLV was up 14% in the 12 months following that first interest rate cut. Now, the S&P 500 was up more, but be aware that 2020, the COVID crisis, was a healthcare-specific crisis and somewhat of an anomaly. But the takeaway from all this, very simply, is that following the first interest rate cut, like the interest rate cut we just saw a couple weeks ago, XLV tends to outperform the S&P 500. How do we know this? Well, we dug really deeply into the data. We wrote about this in our Substack newsletter. We compared XLV to other ETFs within the healthcare system, as well as to the broad markets. And we've been able to detect quite the investment portfolio tool to help preserve capital during economic contractions. We'll provide a link in the description of this video. We hope this has been helpful. We look forward to seeing you back soon.